And I will go into my little piece and see if it's valuable or helpful to you. And then we can also look at whatever you want to look at. So let me do that. And then let me share my screen with you. All right. So I'm just going to give you a little brief, not a beef presentation, because again, I know nothing about cows, but a brief presentation about valuing accounts receivable, which I think is the tough stuff in this chapter. So there's two methods of doing it, and I don't know why they tell you this, because there's really only one that we can use legally under GAAP. So
Each the other one.
well, I think what they wanted to do is like show you why the direct write-off method isn't as desirable by like juxtaposing them or something. But anyway, that's how every book I've ever taught this class out of does it the same way. So it tells you there's a direct write-off method where in essence you just, each time somebody says, hey, I can't pay my debt, you write it off. And then,
so is that why we need to learn the write-off? Is because at some point after the allowances, they get collected. If they don't get collected, then we need to know how to do the write-off, because we'll be using that to get rid of the not collected debt.
correct.
Receivables. Okay.
Yeah. But they also want to show you that just trying to directly write them off without any allowance accounts is going to cause problems, because if I sell something in 1 year and then I decide it's uncollectible in the next year and I write that off, now my bad debt expense doesn't match up with the revenue, and so it just throws everything off, which is why we use these allowance methods. It really works best with the matching principle. So all right. So, but they for whatever reason, they want to illustrate this direct write-off method. So here we have the Warden Company. They write off a $200 balance. So what they're going to do is debit the bad debt expense and credit accounts receivable. Again, that wouldn't be that big of a deal if you were writing off the debt in the same year, the same financial period in which the revenue occurred. It would be fine. It becomes a problem when we cross financial periods. So we sell something to somebody in December, and then in January we decide they're not going to pay us and write it off. Now we've got a revenue in 1 year and an expense in the other that should match up with each other, but they don't. So this is the direct write-off method, and so that's all the reasons why it's undesirable. That's a great word, like it thought it was pretty, but now today it's just feeling undesirable or something. I don't know. I thought it was a strange choice, undesirable. Allowance method is the more desirable way of doing it because it gives us that matching. But what's a little confusing about it for most people is that it forces us to create a special account, a contra asset account called allowance for doubtful accounts. So remember, a contra account is an account that has its normal balance on the opposite side. So a contra asset, like allowance for doubtful accounts, is going to have a credit as its normal balance. The other thing about contra accounts is they're always linked up with a regular account of the same type. So a contra asset is always going to be tied to an asset account. For example, one that we've already learned about is accumulated depreciation. Accumulated depreciation is a contra asset account that's always tied to an asset. And so as we always show them together on our balance sheet, in this case, it would be accounts receivable less the allowance for doubtful accounts, and that would give us the book value of our accounts receivable.
So accounts receivable is an asset?
Correct.
So allowance for doubtful accounts is a contra asset.
Right.
So one of the questions was if the allowance for doubtful accounts, if that gets closed at the end of the period. And it doesn't because is a contra asset account and an asset account does not get closed. Is that why they don't get closed?
Correct.
Okay.
Only revenues, expenses, and dividends get closed, and income summary.
So the doubtful accounts doesn't get closed,
Correct.
and accounts receivable
Doesn't get closed. Those are asset accounts.
is their asset accounts, or
Right.
their asset accounts.
Mm-hmm.
Sorry.
All right. So let's look at an example. So here we have Hampson Furniture has credit sales of $1.2 million in 2017, of which 200,000 remains uncollected at the end of the year. Okay. So what you have to do in real life is at the end of the year, you kind of look at what you haven't collected and you say, hey, how much of that do I think I'm not going to be able to collect? And usually what you do is you base that on previous experience, right? You know, in previous years, it's been some percentage of what you have there that you usually can't collect, or maybe you use aging, like the older accounts are, you know, they're going to be harder to collect. And we'll look at some of those methodologies. But in some way or another, you make an estimate. So this one, it gives you the estimate. It tells you the manager thinks they're not going to be able to collect $12,000 worth of that. So on December 31st, we enter an adjusting entry to get the expense, to claim the expense for that uncollectible amount that we're estimating. And that's what it looks like. So we debit the expense and credit the allowance for doubtful accounts. So at year end, this is what the current assets section of our balance sheet would look like. You would see the accounts receivable is shown there, less the allowance for doubtful accounts. And then this amount right here is what we would call the book value. Sometimes people call it the net realizable value, which I think is even more confusing. But it's just the amount of our accounts receivable that we think is collectible, that we're going to actually be able to get from the customer.
On the balance sheet, it goes into the debit side, but then on the entry you had on the previous slide, it was in the credit side.
Well, so on a balance sheet, this isn't debits and credits. Okay, this is just a subtotal column.
So
they're
okay.
just subtotaling the accounts receivable less the allowance, and then giving you the net of those two here.
So is that the net accounts receivable? Is that what that's called?
Or well, like I said, they either call it the book value of the accounts receivable asset, or sometimes they call it the net realizable value, meaning of your accounts receivable account, or the amount of that is realizable, you're actually going to realize as cash at some point.
So the $188,000 is the net realizable value?
Yes.
Oh, because that was in one of the questions. I had no idea what that was. Okay.
Oh, net. I'm going to write that down.
Gang, hi, welcome. You look like you have the eye of the tiger today, like just focused.
I'm actually sleepy.
Oh.
I'm just trying to keep my eyes open.
I was just trying to build you up. Okay. I was just, you know, she's like, you don't know me. You don't know what my looks mean. All right. Let's see. So then what happens is, so since we did that adjusting entry and we created this allowance for doubtful accounts, now in the next year, when we realize, oh, some of these companies are not going to pay us, we can write off those debts. And instead of writing them off directly to an expense, because we already took the expense last year, in the same year we collected the money and recorded the revenue. So instead of doing that, we now write them off against the allowance for doubtful accounts. So these write-offs always look the same, where we debit the allowance and then we credit the accounts receivable account. And so if you think about that, if I debit the allowance for doubtful accounts and credit the accounts receivable, my net realizable value is not going to change, right? Because accounts receivable will go down, and then the allowance.
This isn't
Actually, I take it back.
Can you repeat that?
No, I'm not going to repeat it because I screwed it up.
Okay. No, like a little bit before. I am very confused. Okay.
So our allowance for doubtful accounts is actually, so I take it back. that net realizable value will change, I think. Let's see. So our accounts receivable is going to decrease, and our allowance for doubtful accounts is also going to decrease. Yeah, so I made a mistake in what I said, so I'm not repeating it. I like to pretend that I'm perfect and never make mistakes.
So
Anyway,
so they had a balance, like, I don't want to say the word budget, but it's like they had an estimation how much they weren't going to collect. So it's
Right.
the $12,000.
Right.
And then somebody goes and pays $500.
No, they don't pay.
Oh, they don't
So
pay.
we decide, hey, this customer is not going to pay us. So usually the way that happens is the accountant that works in accounts receivable looks at it or is talking to the customer, and the customer says, look, there's just no way I'm going to pay you. I'm out of business and I can't pay you. So at that point, the accounts receivable clerk writes up a report, or however they do it at that company, and forwards it to the vice president of finance, and the vice president of finance makes a decision. Like, yeah, we're just going to write this off, meaning we have no intent of trying to collect this money.
So the $12,000 is like a number for all of the receivables, or is
Yes.
not, is just for one company?
Nope, that's all of their receivables, not just one like one person that owes them money.
Oh, okay.
So they make this estimate saying, of all the money we're owed $200,000, we don't think we're going to collect
500.
500, or no, 12,000 of it.
Oh, on that other.
And then the
Okay,
500 is
okay.
money that they actually didn't collect. Like that they have decided we are not going to collect this.
That's why in the entry they have to put dash and then the name of the company.
Right.
Okay.
Okay, wait a minute. I'm gonna have to go back and listen, I guess.
Okay.
If you wrote off, you did the 12,000 before that. And then,
We didn't write off 12,000. We created an allowance for that 12,000.
right,
This was an estimate. The whole purpose of taking the allowance is so we can claim an expense for it at the end of the previous year.
so then they paid 500, that's what the next one is?
No, then we decided, hey, this customer is not going to pay this $500 they owe us. So at that point, we write off the debt, meaning we're going to take it off of our accounts receivable. It's no longer owed to us. So we debit the allowance account, and then we credit their accounts receivable. So now RA Ware is going to no longer owe us anything.
Okay,
And our allowance for doubtful accounts balance is now 11,500, and our accounts receivable goes down.
Why do you put the, never mind, I already know the answer.
Okay. All right. So then someone says, well, what happens if RA Ware, the person whose account we just wrote off, they call us and say, hey, I got the money I owe you. This happens. You'd be surprised. Most people are fundamentally honest. So even if they tell you one week, there's no way I'm going to pay you, and then the next week they come into some money, a lot of them will call and say, hey, I have that money, I'll pay you. So what you have to do is, if that happens, is you have to reinstate their account. And you do that just by reversing the write-off. So your accounts receivable is going to go back up, and your allowance for doubtful accounts is going to go back down. Then you show the cash going up when they pay you.
But the allowance for doubtful accounts go up to 12,000?
No, you're right. I'm sorry. Not down. Back. It goes back up to 12,000.
Oh, okay.
So accounts receivable goes up, and the allowance for doubtful accounts goes up. So this is just a reversal of the write-off. They call it a recovery of an uncollectible account.
so a recovery takes 2 journal entries.
Right, because one, you have to, so what would happen is if I just entered the payment from the customer, my cash would go up and my accounts receivable would go down, and the accounts receivable was already down because I wrote it off. So now that would throw everything off. So instead I have to reverse the write-off and then enter the cash payment.
We did not include.
All right. So in this example we just went through, they just told us the estimate. They said, oh, the finance manager looked at it and said, we're not going to be able to collect $12,000. And so when they did their adjusting entry, it was based on that estimate. So the question is, well, how do they make that estimate? And so there's a couple of ways that they do this. The first is what's called a percentage of receivables basis. In other words, what they do is they just say, this is our whole amount of receivables. So in that last problem, they had $200,000 in receivables and decided they weren't going to be able to collect 12,000, which is 6%. So probably their past experience had told them, we usually can't collect about 6% of the money that's owed to us.
Mm-hmm.
So that's how they made the estimate. So for this way, so what we do is we estimate the amount that's uncollectible, and then this is an important statement here. The amount of bad debt expense that should be recorded in the adjusting entry is the difference between the required balance and the existing balance on the allowance account. Let's see. Oh, no, it's not going to give us an example. So what that means is if I had a balance in my account, in my allowance for doubtful accounts of a credit balance of $5,000, and then I estimated in the next year that I wasn't going to be able to collect $12,000, I don't take the full $12,000 as an expense. Instead, I take $7,000 as an expense and then credit $7,000 to my allowance to bring that allowance up to the $12,000. So each year, that's how we don't, instead of trying to close it out, what we do is each year we just bring that allowance account back up to the amount we think is uncollectible. Does that make sense, or do you need to maybe see that on like an example?
I would like to see it in an example.
Maybe on a spreadsheet or something?
Yeah, I'll pull up, let me pull up Excel. And see if I can make that clearer. All right, so we're going to have our allowance. So at the end of a given year, so December 31st, 2018, this account will usually have some kind of balance in it. Let's just say it has $5,000 as the balance in the account. Okay.
The balance, that the estimation, or
right. So what happened? So think of the one we just looked at.
The 12,000.
They did 12,000.
Okay.
Right, and then they wrote off 500. Whoops, but then they reinstated that 500, right? And then let's say throughout the year they wrote off, you know, another 4,000 and another 3,000, and at the end of the year it has a balance of $5,000. So now at the end of the year, they're ready to do their adjusting entry for the next year to say, hey, how much allowance for doubtful accounts do we need? So again, they would look at the amount of accounts receivable they have, and they'd make an estimate. So let's say the finance manager decides in this next year, again, we're not going to be able to collect $12,000. So instead, in this year of doing I could type, there we go. All right.
That is the journal entry you have to do in the beginning of the year to set up a new allowance for doubtful accounts?
Not a new one, just to bring it to the balance we want, okay? So at the end of each year, we
so
say,
the 5,000 rolls over to the next period?
Mm-hmm.
Okay.
So in the next year, if we decide, okay, we need $12,000, what we're going to do is we're going to do we're going to do a journal entry for 7,000. So we'll take a $7,000 expense. So our new balance will be $12,000. So at the end of each year, what you do is you estimate how much money you need to have in that allowance for doubtful accounts, and then adjust it so that it goes up to the amount you need. And so that's why, so in that first year, they did 12,000 because they needed 12,000 in the account. But then after that year, they still had a balance of 5,000. So the next year when they decided they still needed 12,000 in the allowance account, they did an adjustment of 7,000 just to bring that up to the $12,000 balance they needed. And that's the amount they'll take as an expense.
Don't we need to do an extra entry to show that our balance is 12,000?
What do you mean?
So for the beginning of the period, you will need $7,000. Don't we need to now show that the balance is again up to 12,000? So
that's what I did right here.
Oh, that is on the left. Is that an entry?
Where? I'm sorry. What?
On the where you had it, like where you had selected the 7,000 adjusting entry. I see that $7,000 one. But then what is confusing me is that I look at the $7,000 and it looks like that's a new amount, but the amount is actually 12,000. So don't we have to show an additional entry showing that the 7 plus 5 will equal 12?
Yeah, so we have the balance as of December 31st.
So how do we write that on a journal entry?
Well, you wouldn't write a journal entry. That's the balance of the account. There would be journal entries for all of these throughout the year.
Okay.
And then at the end of the year, we would just tally it up and say, here's our balance, $5,000. And then we estimate, we say we need to do $12,000. So we do an entry right here.
Okay.
And there it is, 7,000. And then our new balance is $12,000.
Okay.
Is
I'm not
this
sure.
something we have to figure out for the test?
Yeah. According to the what we've been going through, I saw like the practice test that for this chapter has a lot of this kind of questions. So I bet one of these are in the exam.
Does that help? Is that clear if I label them like that?
What I'm confused is just I guess it's just the way that is written. Because like on the right side, like that, the formatted entry, the way that it is over there on the left, on the right, that's how I'm
better.
used to.
So she's saying your 7,000
So
area.
on the left, is that a ledger on the left?
Yes.
Okay. So there will be a ledger, and then we'll do an entry to do the additional to get to the estimated allowance.
Because what you have to know is what my unadjusted balance is at the end of the year, and you have to know what they estimate is uncollectible in the next year, and then you have to make that adjusting entry to bring the account up to that uncollectible amount.
Okay, so maybe I'm ahead or I'm behind, I don't know, but I'm gonna ask you anyways. When do we debit allowance for doubtful accounts? I see that we debit bad debt expense, but then when do we debit the allowance?
Right, so then in the next year, so like these entries, here's what they look like. They look like something like this. Okay, I'm not going to type it all out when I have it right here, and I can just copy it and paste it. So each of these entries would look like this. So when that person couldn't pay us, when we decide they're not going to pay us 500 and we write off their debt, that's what it looks like. And then when the next customer, we write off their debt. And so forth.
Oh,
So we
okay.
debit it upon the write-off.
Okay. That is, yeah, now it's making more sense.
Well, and I confused you because I accidentally typed these over on the credit side when I was showing it to you at first. So that probably didn't help.
Seeing it like this is so much helpful. It helps so much.
Is this the only time that the allowance for doubtful accounts would be under debit?
Yeah, so it's only debited when we write off
Okay.
a bad debt.
Okay.
And when you say write off, is when people don't pay or when people pay?
When people don't pay. So when our whoever it is, vice president of finance, declares a certain debt uncollectible, then we write it off, meaning we no longer want to carry that on our books because we don't think we're going to be able to collect it.
Okay.
So I'll give you an example. I own a storage business, okay? And so sometimes people just don't pay me and their stuff gets left in their storage locker. So I put a lock on it and then I let it accumulate. In other words, I keep billing them each month and sending them letters and they don't pay. And after some point or another, I auction their stuff. So if that customer owed me $500 and then I auction their locker and I get $300 at auction for it, there's still a remaining $200 receivable balance that I'm never going to collect because now I've auctioned off all their stuff. So I just have to write that off. I just have to say I'm not going to collect that. And so I do an entry that looks like this. I debit my allowance for doubtful accounts and credit the accounts receivable. Now the customer's balance shows 0 and I just close out the customer's account at that point. So at some point or another, a management person has to make this decision that we believe this account is no longer collectible. And so we're just going to write it off, get it off of our books and take an expense. Well, we're not going to take the expense. We took the expense when we did our bad debt expense entry, but we're going to write it off against that allowance.
So on the far left, that's a T account.
Mm-hmm.
And it's an asset, but it's a contra asset account. So that's why your balance is on the credit side.
Mm-hmm.
Okay.
So maybe what we should do is let me finish up. I think I only have one more slide here, and then maybe we can look at some problems and maybe working through some would be helpful. Always does this. All right. So the other issue is how do we estimate the amount of the allowance or the amount that we think is uncollectible? And like I said, the one way that they show it is what's called a percentage of receivables basis, where they just say we think a certain percentage of what our accounts receivable is not collectible. The other is a more complex method, which is actually more accurate. And this is called the aging of accounts receivable. And the idea is, if I'm like this company right here is owned $39,600, $26,200 of that money is not due yet, meaning the customers aren't even supposed to pay us yet. And so we would expect that debts that are newer, not even due yet, we're going to collect much more of those than we're going to collect of older debts. So again, this would be in real life, it would be based on what the company's own experience has been. And so what they do is they just break down their debts by debts that are not yet due, debts that are 1 to 30 days past due, etc. And then they have some estimated percentage uncollectible, and you multiply that to figure out the total amount that you think will be uncollectible, and then you use that to do your adjusting entry for allowance for doubtful accounts.
So would they if they give us a problem like this, would they tell us a certain percentage is
Yes.
about to be uncollectible, and then we have to multiply and figure out what that is?
Yeah, they would give you all that info. In real life, you would just have to, you'd have to kind of go back and look at historical precedent, right? And sort of come up with those percentages on your own. But in the problem, it gives you all that info. I think that's all I had. Oh, but I guess they have one example. Let's see. So this says, assume the unadjusted trial balance shows allowance for doubtful accounts with a credit balance of $528. Prepare the adjusting entry, assuming $2,228 is the estimate of the uncollectible receivables. So again, we already have a credit balance in our account of $528, and our new estimate is $2,228. So to come up with the amount we would do, I mean, it would be as simple as taking.
So let me ask you this: because that sentence is making me really confused. We assume the unadjusted trial balance shows allowance for doubtful accounts with a credit balance of 528. What does that mean with a credit balance of 528?
Meaning a balance on the credit side, not the debit side.
So you have, so your account, your estimation has $528 left. Is that what
Yep.
it is?
Yep.
Okay.
Yeah. So now they decide, oh, well, according to our new calculations, $2,228 is going to be uncollectible. So how much of it do we have to enter to bring that account up? We just take $2,228, subtract out the $528 that's there, and we have to do a $1,700 entry to bring our allowance account back up to the $2,228 it needs to be. And so that's what the entry looks like. We debit bad debt expense, $1,700. We credit allowance for doubtful accounts, $1,700, and then our new balance is $2,228. And that's it for what I had put together. So what should we do? Should we look at some of those practice questions?
I think that'd be awesome.
Would that be helpful for you, Patricia? See if we can find some of them that maybe were.
Yeah.
Okay.
I think that the one that you have a recording, I think we don't have to go through those because you have a recording solving them. But it's the additional on chapter 8. And I think, let me see which ones I wrote down here.
So the additional self-test here.
I wrote down the ones I got wrong, so.
And the numbers, I think it might scramble them. So I don't know if.
Oh, I see.
I'm not sure of that though. Like, let's look at it and see.
Yeah. Let me compare with mine.
It seems like it refreshes it and changes the number, and sometimes the way they worded the question every time you close it and open it and close it and open it.
Right.
Which is a good practice because then you're not gonna try to.
I don't think they changed the wordings on these. I think
just the numbers or
the number.
No, nothing gets changed. At least on my side. I mean, it's saved.
Okay.
And I've taken them several times before.
Okay.
Mine changed, so.
Yours does? Oh.
Mm.
Okay.
Not this one. The previous sample test that I've taken.
So the 5 one is the one that I had a question. Sorry, I interrupted you.
Oh no, you're fine. You're good.
All right. So is it this one, when a note receivable is paid on time?
Yes, it is the same as mine. Yeah.
Okay. So let's read it. When a note receivable is paid on time and no interest has been previously accrued, what will the journal entry record to record the transaction contain? So So if, all right. So when a note receivable is paid on time, we're going to show our cash going up and our note receivable going down. And it says, so note receivable is paid on time. No interest has been previously accrued. So the other thing we're going to have is like interest revenue. Right? That's what it would look like. So if somebody borrowed $1,000 from me, and then now they're paying me $1,050 with interest, my cash would go up by $1,050.
But it said no interest has been previously accrued. So
Right.
there is no interest.
No, it didn't say there's no interest. It said no interest has been previously accrued, meaning that we didn't have to do an adjusting entry at the end of a year to record any interest revenue at that point. Because remember, if we loan money to somebody, so the assumption is that a note receivable always has interest on it. Okay, so if I loan money to you and then you pay me back within the same year, I'm never going to do any sort of entry for the interest revenue that I'm earning along the way. I just do that when you pay it to me at the end. Now, if I loan it to you in November and you pay me back in March, then at December 31st, I had to do an adjusting entry to show the interest revenue I earn for the year from November to December. And then when you pay me in March, I'll have to do another entry to show the interest revenue I've earned during the new year, plus the interest receivable being paid off from the adjusting entry at December 31st, plus the cash received, plus the note receivable. So when they say no interest has been previously accrued, it just means we have not recorded any of the interest that the note has been earning all along yet. And so we're going to record that when we get paid.
Okay.
So it should be one debit and, oh wait,
2 credits and 1 debit.
2 credits and 1 debit.
Yeah, that's what it is.
Does that make sense or no? Or are you just saying, okay, so I'll stop talking about it?
No, it does. It does. I just have to pay attention. So what I will remember is that
my teenagers do that to me. They'll just be like, all right, Dad. I'm like, wait, so are we good? Or like, no, just it's fine. Like that. Maybe that never happens with your teenagers.
I know where she got confused because the wording, that's how I would take it too, is I would assume that there's no interest
at all.
Yeah, no interest at all. Yeah.
Yeah, and I could see that. Like I don't think it was like a silly mistake to think that. Like it's an understandable mistake. So that's why I'm trying to just say, well, what it means is this. Half the time with accounting, you feel like you're trying to learn their language while you're trying to do the math. And
Exactly.
because the math's not ever like hard math. It's not like calculus. Instead, it's word problems with terminology that you're not accustomed to.
Yeah.
It's kind of rude, actually, if you think about it.
The other question I had was on, it's kind of like the same way, it's the wording that got me, is the number 8.
You think about it, that's how the exams are for this class, right? Like,
yeah,
you'll go back, if you can review them, you'll find that like half the ones you missed were just like, you'll be like, oh, that was dumb. Like, I understood that concept. I just didn't understand the wording or whatever. And that's what blows my mind about thinking about students who are not native English speakers having to read this kind of complex stuff. It's hard enough if you're a native speaker. Like I speak Chinese and I would not want to take an accounting class in Mandarin. That would not be pleasant. Because I can mostly say like, how you doing? Is that a new dog you got? And things like that. Tangible stuff. So number 8, you said?
Yes,
All
yes.
Right. So which of the following is the correct sequence to report receivables on the balance sheet? So here they're trying to, they're trying to show us that, or teach us, I guess, or see if we understand that typically balance sheets are listed in liquidity order. So the current assets first, and then the fixed assets second. And so they have, so the three things they're giving us are a 6-month note receivable, which is a current asset, right? It's less than a year. Other receivables, which leaves us knowing very little about them, and then accounts receivable. So typically speaking, accounts receivable is always, well, cash is first, right? And then accounts receivable is always second. And so what the first thing I would do is I would just look at the two that have accounts receivable first are my, the other two are out. And then a term specific short-term receivable like this is going to be second. And again, I'm not sure I love this question, because if I were you, I'd be like, how the heck would I know? Like,
Or the other receivable.
especially because maybe this other receivable is something that's like super liquid, right? Like,
what threw me off was the 6 month, because you can have accounts receivables that will take more than 6 months for you to collect, and then you have the 6 month note receivable that it's less than a year, and it's saying it's over there.
right.
So I got that wrong. I selected the 6 month was first, and then accounts receivable second.
Yeah, and again, I don't know that it says this anywhere in the book, but if you look at every balance sheet, you'll have cash, then accounts receivable. Like that's always, so accounts receivable is always the first receivable listed. I guess because the concept is most people hope to collect accounts receivable within 30 days to 60 days. Like a 6-month account receivable, because it's not necessarily how quickly you collect it. There might be some you never collect, but it's the intent, right? That this money is intended to be received quickly. But
Okay.
I don't know that that's written anywhere. How do I know that? Well, because I've done it for 20 years and they always write it after the cash. Like, but that doesn't help someone who's new to it.
Can we do number 9 too?
Sure. So which statement is true about reporting receivables on the balance sheet? So let's see, bad debt expense and allowance for doubtful accounts are shown as a deduction from accounts receivable. That's not true, because bad debt expense isn't even on the balance sheet, right? It's an expense, so it would be on the income statement. Allowance for doubtful accounts is shown as a deduction from accounts receivable on the balance sheet. That one looks promising, but I want to read the others. Bad debt expense is shown as a deduction. Nope, because the expense isn't even on the balance sheet. And bad debt expense is subtracted from the accounts receivable and then shown. So it's going to be B. And this is why I think the exams for this class are hard, because it requires a person even who's been doing it a long time to sort of talk through the logic of each of those statements. And that's hard when it's relatively new to you, right? I mean, like anything else that's new, like in a math class, sometimes I just learn how to do the formula and like crank it out. It doesn't mean I actually understand the underlying concepts well. And these tests really seem to try to force that, or that seems to be their goal anyway.
Yeah. Can we do, if we have time, 21?
Sure. Good Stuff retailers accepted $50,000 of Citibank Visa credit card charges for merchandise sold on July 1st. Citibank charges $4,000 for its credit card use. Which of the following are the debit entries required to record this transaction? So typically, and especially I think the way this book does it, when we record a credit card transaction, we're going to show our cash going up by the amount that is collectible, okay? Or not collectible, but the amount of cash we're going to receive from the transaction. And then we're going to do some type of like credit card expense or something like that. They call it service charge expenses. I don't know what that means, but. And then our revenue.
So revenue.
So that's what the journal entry will look like. And so in this case, if we sold $50,000 worth of stuff and 4% of it is our credit card fee, and then the amount of cash we actually collect is like that.
So here's where I have a question. I don't know if it was in this chapter or the chapter previous to this one that we had to do the bank reconciliation.
Last chapter, yeah.
Okay, I was under the impression that we pay those fees later. And this chapter, like, you have to do the calculation and you pay the fees, like you don't even see that money in your account.
So just so you know, in real life, it's done both ways, meaning some businesses would record this as cash of 50, sales revenue of 50, and then later they would go back when they get their credit card statement or from their credit card vendor, and they would record the service charge expense at that point and the cash going down. So that's how some businesses do it in real life. Others do this sort of net method where they say, hey, we know exactly what our expense is going to be. We know it's always 4% of the transaction. So they'll just do it like this. And so for this chapter, they want you to do it this way, where you go ahead and enter the service charge expense at the time of sale.
Okay.
So yeah, I mean, the short answer is in real life, it's done both ways. Different companies do it differently, and they're both correct. This is why you'll like managerial accounting better. Okay, it's less. There's more than one way to solve a problem in managerial accounting, whereas financial accounting is more uptight.
Okay. And then the last question I had, I've studied all those chapters this week, so I might be asking you a question from a different chapter. But there was one thing that you said in one of the lectures, is that to calculate, I'm not sure if it was the days in inventory or something like that. Sometimes they use 360 and other times they use 365.
Right.
So how do I know when the 360 is going to be used?
So I probably shouldn't have said that in the for this book. I believe it always uses a 365-day convention.
Okay.
And more, almost everybody's using 365. So in other words, I probably shouldn't say that because it's just showing that I'm old and been doing this a while. What's happened is when people used to have to calculate this stuff by hand, using just working off this base assumption that you have 12 months of 30 days each, made the math a lot easier. But now that computers do everything, and especially those companies who are collecting interest, they like to get that 5 extra days of interest. Which doesn't sound like much unless you're Bank of America and you have $1 trillion in assets under management, and it's real money.
Okay.
Short answer is use 365.
Okay. Just to be safe, because I was always,
unless a problem tells you specifically 360, I would use 365 because I think everything in this book is 365.
Okay.
That's not what my computer said.
Okay. Yeah, I think I'm good with the questions that I had.
Okay, good.
In the self-study, it used 360, I thought.
In which self-study?
For chapter 8. Yeah, for chapter 8 in the self-study, it had you dividing by, when you had days, it had you dividing by 360.
I was confused with that. I remember seeing that before. That's why I asked, because I was. What page was that, Janet?
It was on the self-study. I don't know which slide it was on.
I think it was the.
It was under the section about notes receivable, because I wrote down divide by 360.
Like I said, unless you're told specifically, sorry, this little thing is in my way. That's not it. I don't know if I'm gonna be able to bring it up. I'm at my work computer and they don't like Flash here.
I can bring it up if you need to.
Okay. What I would guess is that that problem specifically says 360 days.
Well, it wasn't a problem. It was just, it was like where they were explaining stuff about notes receivable.
Okay. Oh, I hate you, Wiley Plus. So again, without knowing what you were looking at, it's hard for me to, is it somewhere in this?
It was probably somewhere in this, yeah. It was under the notes receivable section.
Oh, is there a way to speed this up?
You can do the setting of the speed.
My condolences to you guys for having to do this. I'm sure there's times it's helpful and times it's like, come on. Yeah, I'm not going to be able to.
Computing interest on a note.
Credit manager of hands and furniture estimates that $12,000 in accounts receivable prove uncollectible.
That's disposing of notes. Oh, it might be this section.
Things of months. By counting the months from the date of issue.
Yeah, it says month.
Expressed in terms of days. To count days.
Yeah, it's after that.
The interest on note. Date. Your rate of interest.
It's just after this one.
Is stated in pennies.
Right there.
The time factor is frequently the number of days divided by 360.
Okay, so Patricia,
Yeah.
the answer is probably the dude who wrote this book is also old, and still doing it 360. And so I don't know what to tell you.
Maybe it'll tell us how many days or something.
Again, my advice stands, okay, which is if it doesn't say specifically, use 365 days. If somehow you miss a problem because of that, let me know and I will adjust your score. So if let's say there's one on the test and you're like, wait a minute, this is one where it's not telling me, and if I miss this, I'm going to be mad and I won't know if I missed it because I'm not allowed to review my test. Maybe note the number, and when you get done with the test, just email me and say, hey, would you look at number 12? Because it could be an issue of that. I don't know what else to tell you, because if they don't tell you the number, which convention to use, the 360 or 365 convention, then how do you know?
The way that I've solved in this practice test was because it's giving me the options, so I did both, and then I saw the one that was the closest to the three. I saw one of the options was closer, and it was using the 365. So I was like, oh, okay, so they're using 365 instead of 360. But if it's a problem where you have to type, then I won't know.
Right. So like I said, all I can tell you is I would use 365 if you're, if while doing the test or something you feel like this is a question where that could come into play, let me know. And then I'll go and check it. And then I'll also go and check everybody else's and make sure other people, didn't get it wrong because it decided to use 360 or something like that.
Okay.
That's all I can say. I mean, I have limited control over the test questions, but 365 is. I was really solid in that answer till Janice messed it up and showed me this.
I'm sorry. I'm like, but wait, the self-study says this.
Why do you have to confuse me with facts, Janice? Anyway,
I would have done 360 because that's what this said.
right. Yeah, I'm not a fan of this issue right here. Anyway, okay. So we're it's getting pretty late. Is there any other things to address before we adjourn for the evening?
No, I'm good. Thank you.
Okay. Janice, you good?
I think so.
All right, Ging?
I'm good.
All right. I'm glad. She's sleepy, but she's good.
Yeah, I'm here.
Did you say you're in Eastern time zone?
Who?
Ging, you're Eastern or Central?
I'm Mountain.
Oh,
For now, I'm in Arizona.
okay.
So
Oh,
they're
that's
having
right.
daylight saving next week.
Well, we don't change because we're Arizona.
Yeah, we don't change.
It's our rebellious nature. Anyway.
Utah wants to stay in daylight savings time.
Yeah, so what'll happen is next week we'll continue meeting at 6 o'clock, but for me that'll be 5 o'clock, so it'll be weird. It happens every year. It's just weird. All right, if we're all good then why don't we conclude with a prayer? It can't be Patricia because she had to say the opening prayer. I didn't have to. She had the opportunity to be blessed by saying the opening prayer.
I got to pull food out of my Instapot.
Okay, so it can't be Janice because she's pulling food out of her Instapot. So again, it's either you or me. What do you think?
I'll have you say it this time.
Okay.
I said it last week.
Okay. Seriously, recently I was interviewing an 8-year-old for baptism, and so I usually try to ask them to say the prayer. I like to hear them pray, and I said, "Would you be willing to say the prayer?" And the 8-year-old goes, "Oh, you can do it."
Oh.
I'm like, man, I never would have talked to my bishop. I would have been too so maybe maybe I was like, okay, I guess I'll say the prayer then. And I did. And it was all fine and they got baptized and it was beautiful. But I just thought it was funny. Anyway, okay, I'll say the prayer. Our dear Father in heaven, we love thee and we come before thee with gratitude for the many great and manifest blessings in our lives. First and foremost, our membership in the Church of Jesus Christ. Or even more importantly, the atonement of our Savior, his love for us and his willingness to suffer on our behalf. Please help us to grab hold upon that atonement, to repent of our sins, and to allow it to change us and make us who thou would have us be. Help us to gather Israel, to bring them in, and to strengthen ourselves and our families. We love thee, Father, and again, we're grateful for this opportunity. I ask thee, please bless these students that they might learn and attain the skills they need to strengthen their families, strengthen their career prospects, and do the things they need to do. We love thee, and we say this in the name of Jesus Christ. Amen. Thank you.
Thank you so much.
Thank
Have
you.
a great night.
Thank you.